Hello everyone and welcome back to another video, and in today's video we are going to talk about everything you need to know about our three entry models that we have to make sure we can capitalize on certain situations in the market. So you've seen the strategy, you've seen how we trade, and in this video we are going to cover everything you need to know about our entry models. So let's get into the charts. Now, we're on the charts, and what I want to run you through now, as I said, our three entry models. And basically these are different ways that we can enter the trade to make sure we can capitalize on the trade itself and make sure we can get as best risk to reward as possible. Now, I will preface this video by saying these are risky entries that I'm about to go over. Now, one of them is our standard entry model, and that's what's been used when we've been back testing the pair, and that's what we use 90% of the time. Now, that is what we call a candle close, a directional candle close in our favor. Now that's what we use 90% of the time, and that's where your win rate is going to be your strongest. Now the other two strategies, they are what we call a little bit of a risk entry. Now I would only use these in a case where maybe I'm up in profit for the month and I can afford to be a little bit more aggressive with the trade, or I can clearly see that once the trade has come back to our zone, it's rejected heavily and price is moving quickly, and I can clearly see that. That's when I might make use of these other two entries. Now I'm going to start by just talking you through the candle close. Now again, this is our, if you like, bog standard entry that we use on 90% of our trades, and is by far the safest one that I would recommend for you guys to use before you get to grips with the other two entries, just because they can be a little bit more complicated, the other two entries, as to when and how and why to take them. So the first entry is a candle close. Now what this is as you can see here, we've got our demand zone drawn out, we've had a move up, we've had our liquidity, we've had that liquidity being taken out, and now we're just waiting for it to come back to the zone. Now once it comes back to the zone, we can see here, we get the first bearish candle, obviously taps the zone, rejects. The second candle closes bullish. Now that would be our entry point for this trade. And as you can see, the trade, if I zoom out, it did actually end up going for a 1 to 6. That's on the candle close. So if I just show you to the right, there we go. That is actually a 1 to 6 on the candle close. But this entry was actually valid for one of our other risk entries had you wanted to take it. So, but like I said, the candle close is the type of close or entry point that we're going to take 90% of the time. So we simply wait for this 5-minute candle to close. We'd put our stop loss a pip below the lowest candle in the zone, and we would take the trade and simply let it run. And that's where we need to have patience when it comes to these things, where if we want to be safe, we want to be, or not mitigate our risk, but certainly lower our risk and increase our win rate, we're going to take the candle close 90% of the time. And like I said, this trade was actually valid for one of the other entries, and I'm going to talk you through that now. Now, again, I just want to preface this and make sure it's clear to you guys that these two entries, if you're not used to them and you haven't got to grips with them, I wouldn't recommend taking straight off the bat. Only once you've got used to them, you've built that picture as to what a setup looks like when that entry takes place. Now, this is what we call a flip entry. Now, a flip entry would be, we have our move down here, the first candle rejects heavily, and it closed quite far from the zone. That's one of the reasons why we would want to take a flip entry, because if it rejects heavily from the zone and our entry is actually quite far from ideally where we'd like it to be, we can get on a flip entry to make our risk reward as best as possible. Now, a flip entry is only valid when the first bearish candle comes down, it rejects. The next candle comes down to the zone again, and you must have two zone taps in order to take this entry. It comes back and it flips back to being bullish. Obviously, so when this candle opens here, you're going to get the bottom wick being made, as we know from looking at pretty much every single candle on the market. Candles like to make either a bottom wick or top wick and go in their intended direction. So that's why these entries are sort of, what we're doing with these entries is sort of preempting the candle close, if you like. We're sort of predicting that the candle will close bullish. Therefore, we want to get a better entry. So this is sort of like an intuition thing, if you like. So like I said, this flip entry would be where that bottom wick has been made. So that bottom wick down here, it's come down, it's rejected out of the zone, and it's turned to being bullish again. Now that would be our entry point. Now, like I said earlier, if we had have taken the candle close, which would have been up here, that's a 1 to 6. Now, if we can afford to be a little bit more aggressive and take the candle flip, which would be there, that's a 1 to 10. Now, that's a 4% difference into risk to reward between those two entry points. So that's why we like to take maybe sometimes a risk entry, as in a flip. And by no means would I recommend taking a flip entry every single trade, because it is going to dramatically decrease your win rate. Yes, you might get some better risk to reward on the ones you do win, but what you've got to be careful is sometimes this second candle here coming down, it goes back bullish, but maybe like a minute before the candle closes, it actually closes down here somewhere. And as we know, when candles tend to close bullish, there's not enough bearish, there's not enough buying power. So the trade's likely going to lose. So we only really use this if, one, we can afford to take a little bit of a more aggressive entry, and two, if it rejects heavily from the zone and we can clearly see that price is moving very, very quickly. So there's a lot of volume behind it. And that's the only situation we would take flip entries in. Otherwise, it's the close of candle. Now, that's those two entry models. I'm just going to talk you through the other entry model that we have, and it's sort of in between the two, if you like. And in certain scenarios, it can pay off, and again, can get you a better risk to reward than the closer candle, but it's not quite as good as the flip entry. So let's get into that, and I'll quickly talk you through a trade that has that on. So this is the last entry model that we used, and again, it's part of the strategy, but it's not one that we use all too often, only in very certain scenarios. Now you can see this is a sell setup. So again, we have everything that requires the trade in order to enter the trade, So we get our move down, we get our liquidity, which would be here, and we have our break of structure, which would be here. So as you can see, we've got that pattern, we've got a move down, retracement, break of structure, and we come back up to the zone. Now this entry is what we call a break of candle entry. So again, we're sort of preempting the direction of the market here. We're sort of predicting it already before the candle closes. And as you can see here, again, we get the move up to the zone, and this candle actually rejects pretty heavily. So we can see there's a lot of selling power there. Although the candle didn't close bearish, we can see there's still a lot of selling power there. And we're sort of preempting that the next candle is going to end up closing bearish. And that's why, again, we don't take the close of that candle because it's closed bullish. The other candle could have just as easily came up all the way up here and tagged us out, and then the trade end up losing. So what we wait for is the candle would open up here, it makes its top wick, and again, we always like to see candles either make a top or bottom wick and then move in their intended direction. So we always wait for the top wick in this case first. And then instead of taking the flip, because we can't take the flip because the candle closed bullish, So what we take is the break of candle. So that would be just below this bullish candle here. Now, what that does is, again, just improves our risk to reward that we get with the trade. So here we can see that's a 1 to 4 point if we take the break of candle properly. That's a 1 to 4.5. Now, if we had taken the close, that's a 1 to 3.5. So that's an extra percent. Okay, a percent doesn't sound all that great, but imagine this bearish candle here would have closed down here. That's when the risk to reward is not in our favour to really get in the trade, because then we're only looking at 1 to 2.2. Get my words out. So that's when we would want to take the break of candle. Now, again, we only take the break of candle when we see that massive rejection and we can clearly see prices moving in our intended direction. And that's when we would take those two risky entries as opposed to the close of candle. But like I said, 95% or 90% of our trading would be done waiting for the close of candle. And the closing candle in this case would have been the close of that bearish candle there. 1 to 3.5, that's more than enough to take. But this, the only reason I'm talking you through this is because it was valid for a break of candle. So they're the three entry models that we use. Now again, risk management wise, always we're going to put the stop loss below or above the highest or lowest pip in the zone. In a sell situation, it would be above the highest wick. In a buy situation, it would be below the lowest wick. And we always give ourselves a pip room distance just in case price decides to come up to the zone again and maybe take out the high of that wick and then move in our tender direction. Again, we've had that loads of times. So risk management wise, always 1%, always give ourselves a pip breathing room. And like I say, these entry models, like I said, the closer candle is the one we take most, but the flip entry and the break of candle are sort of like an intuition thing when we can sort of predict the direction of the market that we're about to get a big move either up or down in our intended direction. So again, have an experiment with those entry models. What I would say is if you're not comfortable with the strategy just yet, just stick to candle closers because it's what we trade with 90% of the time. So therefore, if you're not comfortable with the strategy yet and you're still trying to find your feet with it, just stick to either back testing or forward testing on the closer candle, and your win rate is going to stay to where this strategy should be, which is about 60-70%. So again, like I say, you can take those other entries, but I would very, very much advise you to get to grips with them first, understand why we take them, how we take them, and when we take them. And if you can get to grips with all of that, hopefully you can start taking them in your own trading and therefore making the risk to rewards that we sort of do sometimes when the trade gives the entry. So there we go, that's the 3 entry models. Get to the charts, test them, figure them out, understand them, and you'll be there in no time. So if you enjoyed the video, don't forget to like and subscribe and comment any feedback you have down below in the comments and we'll get back to them. And as always, we have a Discord, so I'll leave the link in the description. And like I say, it's free at the moment, so do come over, come and have a chat with us, come and trade with us, and we can answer any questions that you may have. And that was my alert, just went off for a trade, so I'm going to see what that was.